Hi there, I'm David Pipe, and I'm here with my co-host Rob Kent. Today, we're here to talk about down payments and what you need to know about down payments when you're purchasing a house. So, first of all, why is this important? Down payments are one of the most hot topics when it comes to purchasing a home. It's often, the biggest barrier, the thing that stops people from getting into the market, as well as the thing that stops people from expanding their portfolio into their second home or their investment property or their cottage. So, we found an interesting stat in a report that came out that said that based on today's affordability, that an Ontario millennial would need to save up for 20 years just to get the down payment. Now, obviously, that's never going to work, and it just is a bad, sad fact of the state of the housing market. But the truth is that there are ways that we can help to increase that process as far as making it easier to get your down payment, and also just think about ways that you can get into home ownership at a time that works for you. So we thought we'd dive in and tell you a little bit more about everything you need to know about the down payment. So Rob, why don't you kick us off? How much do you really need?
Yeah, so this is a question that I get asked all the time. Like, how much of a down payment do you have to have? So the answer is it depends. So minimum would be 5%, and the 5% would be up to 500,000, and then after that, it's 10% up to a million. In which case, after a million, you would need 20%. Unless if you are purchasing an investment property, you would need 20% down, but again, that would depend. If you're buying an investment property and you're going to live in it, then you don't necessarily need to have the 20% down. It would just be anywhere between 5 to 20%. So in a short answer, or as short as answer as I can give you, that's kind of what you would need for a down payment. So David, tell us a little bit about the insured versus conventional.
Very exciting stuff, of course. Insured versus conventional. That
Yeah.
really, that's just another way of sort of explaining the difference between a down payment that is under 20% and one that's over 20%. So insured just means that the purchase was insured using what people will call the CMHC, but there's actually three insurers, and the point is that if your down payment is under 20%, then you'll need to purchase mortgage default insurance. The lender will add it on to your mortgage right away, and then it will be basically built into your payments. It doesn't affect your qualifying, so you don't qualify for less because your mortgage is insured. It's the same as far as the cost of the insurance goes. But mortgages that have between 5 and 20% are considered insured. And then beyond that, you would call it conventional. Conventional just means that it's a traditional mortgage in that they don't need the insurance. Sometimes they'll buy it anyways without you having to pay for it. But in general, that just means that you might get more flexibility from the lender because they don't have to satisfy the same rules as they would when you have under 20%. So insured mortgages tend to get really good rates because the insurance helps them as far as what the bank has to worry about for risk. Conventional mortgages don't have to pay the insurance fees. So you tend to, in some cases, pay a slightly higher rate, believe it or not. But in exchange for that, you don't have to pay the insurance fee. So that's how those things sort of work out. The next thing to dive right into, too, while we're at it, Rob, is so how do you get it, right? People talk about whether or not they have, they're at 5%, or whether they're trying to save for more, or what they want to do. And honestly, one of the biggest things that people work towards is how do you get the maximum down payment that fits your situation. So, with that in mind, here are some of the top sources and strategies for your down payment. And this can apply to all, not necessarily just first-time buyers, although the first one is first-time buyers only. So RSP, so there's a program called the Home Buyers Plan. It allows every first-time home buyer to take up to $35,000 each out of their RSP as a basically loan to themselves. So if there are two borrowers, you could take 35,000 out of yours and 35,000 out of whoever you're buying with, your partner, family, spouse, whatever it is, and then you can use that towards your down payment. The benefit here is that it doesn't count as an RSP withdrawal, so you get to keep the money technically in the RSP, and then you just pay it back to yourself slowly over the next up to 15 years. So each year you would just recontribute back to your RSP, and they would mark that contribution as a repayment. So it's a good way to be able to use those funds that are in your RSP without having to pay tax on taking them out. The other great thing about that is that if you maybe were planning on starting an RSP soon, but you haven't, for a lot of first-time buyers, it may be a good opportunity to start using the RSP as a way to put some money down, get the tax benefit of contributing to the RSP. And then as long as the funds are in there for more than 90 days, you can withdraw them under the home buyer plan. And so that's a really great way to be able to get a tax advantage and to save up for your house. The second part is savings. So of course, it could be your tax-free savings account, it could be your own personal savings, it could be a gift, it could be any other source. And the government's working on a new account called the home, like tax-free home account, which is basically similar to a TFSA, but it allows you just another spot to save up for your down payment. So that's number one. Another one is borrow. So a lot of people ask me this question: can I borrow the down payment? And the answer is it depends. But on a mortgage where you have 5% down, that 5% has to come from your own funds. You can't borrow the 5%. But if you have 10%, 5 of it can be borrowed. If you have 20%, basically the first 5% has to be from your own savings or your own sources. So it could be savings, RSP, but the balance can be borrowed. So if you have a family member or if you have a line of credit, that's pretty common too. I have had clients with maybe they had a line of credit left over from when they were in university, or a line of credit that they had used for a major purchase that they paid off. So you can borrow for the down payment. You do have to factor that into your payments when you do the application, but you can borrow it. And that might be a way to improve the amount of down payment you have, and maybe reduce the insurance premium. Maybe you have only 5 or 6%, and if you borrow the rest to get up to 10%, then you can reduce the insurance premium. So there are some reasons to consider borrowing when it makes sense, or maybe to get from, say, 15% over 20% if you're trying to buy a rental property and you need to get 20%. And the last one is using your home equity. So a lot of people, this video is not just for first-time buyers. They have an existing home and maybe they want to buy a cottage or an investment property. So you can use your home equity. You can borrow against your own home. It's a very common strategy and often used by people who invest in multiple properties. So certainly you can use your home equity, but those three are the main ways to do it. And there's lots of different ways to reconsider it. So of course, we can talk more all day, but we won't get into the nitty gritty today. So Rob, I mean, those are sort of some of the ways that they can, acquire the down payment.
Right.
What do they need to know about, like, whether they should wait or save? Do you get that question a lot?
I do get that question a lot as well. Yeah, how long should you save for? I mean, it depends. There's no right or wrong answer here either. I mean, most of the time, it makes sense to, if you have the down payment, to buy when you have the down payment rather than try and save up, for to get to 10% or 20% or whatever, or even more than 20%, because with the value of homes going up, and it just depends on the market that we're in. If you're in a market where the home prices are going up astronomical, it doesn't make sense to wait, right? Because if you can afford the home at that time, it just makes sense. Now, if you're in a market where maybe it's a little bit slower, and you do want to save the 20%, maybe home prices are coming down, then yeah, maybe it might make sense to wait a little longer. For my experience, though, it makes sense to buy when you do have the down payment rather
Yeah,
than try and save up, right?
I get that
So
too.
there's
People
not too
say,
many instances where you want to wait, but
yeah,
there
yeah,
are.
yeah. I get it. It's like, hey, I don't want to pay the insurance, right? Like, hey, the
Right.
the
Yeah.
mortgage default insurance or the CMH, it's high. I don't want to pay it, so I'm going to save up to get the 20%. But
Yeah.
it can be
A
hard
lot
to
of
do
the
the math.
time, though, yeah, do the math, because a lot of the time when people think that, you're gonna end up paying more for that house than you would on the savings of the insurance, right? And it just mathematically just doesn't make sense. So you want to make sure either you or somebody's doing the math on that to see, if you're going to be ahead or not.
Not to mention, you wouldn't be able to live in the home. Like if you're saving
That's
for
right.
for a couple more years, right, or
Yeah.
another year, or hopefully not 20 years, but then
Right.
you're not enjoying the home, so you're not building any equity. And
Yeah.
well, yeah, you may get a bigger down payment and save money on the insurance. There might be some other things. So sometimes you're right. Like look at the big picture a little bit and see what makes sense for you.
It does, yeah. And if you're renting, I mean, if you think about it, right now, you're not putting equity in your home, and you're paying rent a little bit longer, and you're now, um, you're kind of lining the pocket of the landlord. So you're paying his mortgage rather than paying your own mortgage. So you
Yeah.
want to think about those things, right?
Right, right. No, it's exactly a lot to think about for sure.
Yeah. So where do you go from here? Yeah, our contact information's here, phone number, email, social media. Check us out on social media. We've got other videos as well. Check those out. If you have any ideas of any videos you'd want us to record, feel free to reach out, and we hope to hear from you soon.